Hello, everyone. This is episode 12 of NAAIM Confidential, where we talk with active institutional investors and discuss their approach and outlook. Today, we have Buff Dormeier. Buff is the chief technical analyst at Kingsview Partners and the author of the book Investing with Volume Analysis. Buff, welcome.
Hey, thanks for having me on, Asher.
Great to have you. Let's just jump right into it. We like to start by taking a look at the NAAIM Exposure Index. This is an index, it's a survey of the NAAIM members to asking about their equity exposure. We had 103 and change there. So that indicates that on average, NAIM members were slightly leveraged and had more than 100% of assets exposed to equities. Tick up from 93 from last week. Buff, does this correspond to what you saw in the market over the past week?
Well, the capital flows keep on driving the market higher. So yeah, it makes sense that lots of NAIM members are long here.
Yeah, it looks like we've kind of had a series of weeks with not much of a decline. How are you reading this?
When this sentiment indicator is this high, of course it's a warning sign that things are toppy or becoming a little bit overdone. So that certainly brings me pause when looking at any sentiment indicator when it's this high. Does it mean that you should sell off? I don't think so. I think that sentiment is kind of a good judge to see what other people, how they may be feeling, and maybe people are a little opportunistic, maybe a little bit euphoric here. That's certainly something to consider. But if you're a position trader like me, it's something to just kind of to take note of, but not anything to act upon. I think that sentiment is more useful during the other extremes of extreme pessimism. That's where I think sentiment can actually be beneficial in actually changing your market position, but not necessarily, upward trends, upward movements can persist. And to try to call a top can be a dangerous occupation because you could lose your position in a strong market.
So maybe a sign not just to kind of hold off and not to establish new positions, wait for a better entry.
That's how I look at it. Yeah.
We can see at the last time we were pessimistic, it did look like a little market bottom. And luckily, it looks like members were quick to adjust higher and catch that uptrend. So you're the chief technical analyst at Kingsview. Can you tell us a little bit about your approach?
So my approach is very narrow. Of course I use technical analysis, but specifically I narrow in on using volume, following the flows of capital. So my role is on the firm. I help our RIAs, our AIRs to by producing some market commentary, managing I'm also a portfolio manager, so I manage portfolios for them, and some ETFs and things along those lines to help assist them in their wealth management.
So these portfolios, they're technically driven? Do you combine any other indicators, or is it kind of like a rules-based thing?
So everything that I do is very data driven. Some would even say a quantitative approach. So there are some strategies that are purely technical, and there are some strategies that combine fundamentals and other factors and variables into the decision making process. I have a strategy that just came out as an ETF, volume factor. That's what I deem it, the volume factor. The volume is not only not only a set of data or a leading indicator, but is also a factor of investing. And so like in the dividend program, we start with fundamentals. I really big into free cash flow, so we narrow the universe down by free cash flow, and then the idea of the dividend strategy is the dividend tree. We want to produce more and more income, particularly for those firm clients that are in the distribution phase. So they have to have really strong free cash flow. They have, which is really the root of the tree. They have to produce fruit, which is of course the fruit of the tree, and then they have to have they have to grow new branches, which is dividend growth. Once I narrow that criteria down, then we want to find which of those dividend trees are ripe and poised for growth. And so that's where we use the volume factor and technical analysis to identify, once we identify the types of companies we want to own, which ones of these are ripe and poised to move.
That's interesting. So volume as its own factor, just like growth, value, profitability. So you're looking at volume as a driver of investment returns.
Absolutely. And there's data out there that I believe proves out this volume's not only a factor, but it's the factor that rules them all. Because if you know where the capital is moving, then you know which factors and styles, industries, sectors are in vogue.
Yeah, sector rotation is it's a nice idea in theory, but in practice can be hard to implement. Have you had luck using volume in a sort of sector rotation approach?
I wouldn't call it luck,
Okay.
but I think there's a lot of validity in understanding where the money's flowing, and volume and price trends have a relationship. Volume and momentum have a relationship, and it's understanding how that dynamic works can help produce results for your portfolio.
I'm sure you have a lot more to talk about this. Do you have something you can show us?
Yeah, I sure do. Let me share my screen here. Okay, so to go off of that, let's talk about this is how I apply volume analysis in following trends. And so if you think about this, first of all, I'm going to talk about two things. We're gonna talk about volume, and I like to think of volume as force. It's synonymous with force. When volume is rising, that is energy, okay? But when volume is falling, it operates under not under the laws of entropy, but energy, but the laws of entropy. Okay, and there's so if our first illustration here is we have a trend that's up and it has rising volume. And so I like to think of another analogy here. An uptrend is operated under the laws of greed, whereas a downtrend operates under fear. So we have in our first quadrant here, we have price expansion and volume expanding. So with the trends going up on rising volume. So here we have greed with energy. And so the market's in a state of invigorated greed or strong demand, the uptrends being confirmed by more people willing to participate at ever increasing prices. And so the future outlook of that is the implication is bullish. Next, we have a trend that's going up, but on following volume, so dropping volume. So this is greed, not with energy, but with entropy. And so this is a market that's complacent or under weak demand. And the uptrend is being contradicted by fewer and fewer people willing to purchase at ever increasing prices. The implication going forward would be bearish. So next we have a trend that's down on high volume. So that's this fear with energy. So this market's in a state of fear or a strong supply. The downtrend is being confirmed by more and more people willing to sell at ever decreasing prices. And the implication moving forward would be bearish. And then finally, we have a downtrend on falling volume. So this is fear, again, with entropy, or the market's in a state of apathy or weak supply, the downtrend's being contradicted by fewer and fewer people willing to sell at ever lower prices. And the implication there is bullish. So one of the ways we use this, if we can use this, switch this from trend to momentum. One of the most popular momentum indicators, this is internal momentum. Internal momentum is looking at a stock compared to what it has done in the past. That's not the same as relative strength, RS, which is comparing a stock to, say, another benchmark like the S&P. RSI is comparing a stock's own momentum compared to where it's been in the past. When doing a RSI study from 2002 to 2023, we found that owning the stocks that had the current RSI deciles actually underperformed the benchmark by about 2%, whereas the stocks with the lowest RSI, the lowest momentum, actually outperformed. And if you were to look at a different time period, the results could be exactly the opposite, because momentum works when it does, and sometimes it doesn't work. Now, what we can do to improve that results is use a different indicator called the money flow indicator. Okay, this indicator is exactly like the RSI, almost exactly, except it weights the indicator with volume. And so when we add the volume information to the RSI, we take a indicator that lost 2% on the top decile and created one that made 2% on the top decile.
Yeah, that looks like a big correction there.
Yeah, it really helps out with, it can really help out with the results. So here's a chart, just a stock chart on top. RSI is plotted underneath that, and then we have MFI on the bottom. And so when you take the difference between those two, and this is where everybody kind of misses out, is really not so much MFI by itself, but what's the asymmetry between momentum and price weighted momentum, okay? And that difference, that delta, is this top line result here. So here we're looking at stocks with, say, high MFI and low RSI. And that top decile results, we improved from, I think it's like 12.4, 12.6 to almost 20% returns in the top decile. So this is really the big critical piece in how in our analysis that I like to look at and use volume. It's not just volume, but how it relates to price trends, how it relates to momentum, because it's understanding how do volume and price relate, because they're both siblings of one another.
So you found that when there's a divergence between just a standard price-based RSI and then a volume indicator, when there's a bigger difference there, that's when there's an opportunity.
Yeah, so when the volume is confirming the move, the MFI will be higher than the RSI, because really the same index, one has volume, the other one doesn't. And so we're really looking at the asymmetry, the delta between price momentum and the volume weighted price momentum.
Okay, so this looks like a case study in Phillips 66.
Yeah, this is a stock that has been showing strong asymmetry right now. So Phillips 66, this right here is the money flow index on the bottom in green, and we have the RSI below that. And see, RSI has been climbing, all that's positive, but the MFI has been moving even stronger. So we could see that this that the money flow index, which is up in the 80s, whereas we're just now getting the 70s in the RSI. So MFI is leading was leading the RSI higher, and still is, even though it's kind of gone sideways here for a bit.
Yeah, it looks like when it crossed 50 there, that would have been a good time to buy.
On this indicator right here, that's just MFI alone. It could have been, but again, what I'm really looking for is how it relates. These two relate to one another. Okay, MFI on its own does good, but understanding how it relates to the RSI is really the key data set that no one's really looking at.
So that's the advantage.
That's a huge advantage. It's the difference between what I just showed you in those previous results. It's
okay. Was there an indicator showing a differential between those on that chart, or was it
yeah, there was. So this has it kind of inverted here. Both of these two have different, the red and the green on top. So the lower it goes, the could be the stronger the indication. Okay. Also, you can see here, like these points of major extremes can also be signals here too, of both ways.
Oh, like when it makes a reversal.
Yeah.
I see. Cool.
And so the next piece of that is that's how you use it with stocks. And and if you are a position trader, what's really important is how do you follow the trends of the market, because it's the trends of the market that define whether you're in a bull or a bear market, and how you invest in whether you're in a bull or a bear market makes really all the difference in the world. So the problem with volume analysis is that the data works great with individual stocks, but the data in indexes isn't. There's very big deficiencies in index data in reporting volume, and so the reason is because most people, when they look at volume on an index, they're using tallies, but most indexes are comprised of capital weightings. So one weights a portfolio based on price and capitalization on this, and the other is just a tally. Well, when you're tallying volume, the stocks that tend to be the smallest, the penny stocks, often have the most volume, whereas the biggest stocks, like for instance, given this market and all the notoriety of the Magnificent Seven, those stocks are generally higher priced stocks, and so they may have high volume because they're being traded a lot, but nowhere near their capital levels. And so what I've done is I've corrected that through capital weighted volume. We can identify how much volume is in an index, like say the S&P 500, and then we can break that down, parse that into how much volume is up versus how much volume is down. So for instance here, last week, we had almost 3 times as much money coming in to the market as money going out. So you can see here the green bar is inflows versus how the red is how much money outflowed. So through this tool, we can either through volume track how many shares capital weighted are moving into the S&P 500 or any other index, or in this case, we're looking at dollars. How much money, capital, has moved into the market. Of course, what we want to do is we want to be in the market that is showing positive capital flows or positive liquidity through volume. And so this is what this chart shows, is when the red dots, red arrows, are when we go below trend, and the green arrows is when we go above trend. And the idea here is we want to be in the market when the trend of capital flows is positive. This is capital weighted volume.
You take uh, the share volume of the constituents of an index, weight those by the price of the shares, and then recombine them to make a volume indicator for the index.
Yeah, it goes a little further than just the price, because you have to know the capital weightings. So it's like, so if Microsoft is currently the largest member of the S&P 500, you have to weight it for its weighting within the index. So that way, what's most important about its volume is how it relates to price. And so what we want to do is we want to get that with capital weighted volume, we're actually getting that to a 1-to-1 ratio, so that for the price and the volume to be exactly in sync. So if Microsoft's has a 9% weighting in the index price index, it would have the same impact on its volume, would have the same impact on a relative basis.
So you're building an indicator for the index that should function just like volume does for individual shares. It should have the same conceptual meaning.
Yeah, it does, except it goes further with indexes, because in a stock, you don't know whether the volume is positive or negative. It's a trade. You can infer plus ticks and minus ticks, but with an index, you don't have to make any references. The stock's down, that's capital moving out, and if the stock's up, it's money moving in. So you can add a whole nother dimension with indexes that you can't with stocks.
Very cool. Very cool. It looks like there are a lot of false sell signals, but they get reversed very quickly. But the true false sell signals keep you out of the market for a good amount of time.
That's right. So you can see that significantly reduces the risk if you look at like those statistics and standard deviation, Sharpe ratio, downside deviation, because it's the bear markets that destroy financial plans, and more wealth is being moved into that distribution phase, where managing risk is so much more important now than it was during like the 90s or even the financial crisis. More people are taking money out of their portfolio to live off of, and more monies have been driven towards the equity markets given the low returns in yields. And so using risk management is extremely important in today's markets.
Yeah, it looks like you're on this chart, you're in the good times and out in the bad time. All these little sell signals that just don't last. That's great. I can't argue with those numbers at the bottom either.
This is volume, and this is adding dollar volume. So this is the same thing, except we're now looking at not the volume, but actually the capital. This is actually money by adding the value of the stocks as part of the equation, and it looks very similar. The risk is a little higher, but the concept's the same. And so what I like to do is I like to look at these. If anybody that subscribes to my volume analysis update, I have a flash update. This is what we talk about. Like, for instance, those advisors, we talk about what's happening with these with volume and what's happening with capital flows. So I like to use these together to base our equity position. The other piece here that I'm illustrating in this chart is that, so to kind of go through it, we have an offense. I kind of describe that offense of looking at the asymmetry within each individual stocks between price and volume. Then that defense is that risk overlay where we're following the market itself and determining whether we want to be fully invested or something less than that, based on what's happening with the S&P. And then if you're on a defense, what most active managers lack is the special teams units to transition once you're on defense back to offense. And that is really important to have that special teams unit to transition, because usually the biggest move in the market, particularly a bull market, is its birth. So when a bull market is born, those are generally the biggest percentage increases in your return. So when we're looking at things like we were earlier with the NAAIM index, when that sentiment got way low, that is generally, particularly like in 2022, and what was it, October of 22, that NAAIM index got really super low. Well, this is kind of what we're looking at here. We're looking at volume. This is what this indicator is, the volume price confirmation indicator. And when it gets really low, like a really low, and then crosses under a Bollinger Band, which is a standard deviation, and that's telling you that that's a setup that people are selling out. And particularly, I'm using the spider. The same reason that someone might use the NAAIM index, I'm using the spider, because the spider is a tool used by retail investors. Okay. And so these retail investors aren't the NAAIM people. Okay. These are the people that are driven by their emotions, of greed when the market's moving up, and of fear when the market's moving down. And so what we want to do is we want to do the opposite of what these people are doing. Okay. We want to do the opposite of what the people that are that are investing in the spider. So when they get to an extreme level of a sentiment, okay, that is the time to get back in. And so what we're looking for is that setup of it to fall to a real low number, the VPCI, fall below its Bollinger Band. It's telling you is way below its historical average. And then the trigger is for it to turn back up. When that turns back up, like here of March 9th, 2009, which is one of my best signals ever, that tells you that the market has capitulated, and all those people that were selling out of fear are gone, and we can now safely re-enter the market. Another one of these here is this is hard to see with this, I can't move that. This was March 19th, 2020. We had another VPCI signal. This was actually just, I think it was 3 days before the low, the actual low. There's another signal that I use. It's called the W bottom. The W bottom, it doesn't have to get as low. The criteria I'm looking for in the VPCI is below -4. But if it's below 0, that tells us that we're in a bad condition, but it's not overly depressed. So when it's not below -4, it has to happen 2 times in a row. That creates the W. So it goes underneath that we don't take that signal because it's not deep enough. But the second one, if it happens 2 times in a row, that's the W. That happened here on September 30th, 2022, the day of the low. So next day, that was again, perfect timing using the VPCI W bottom. And so when we add, this is just the V's, that doesn't even include the W's. So when we add the V to our system, it really helps boost our returns, because we're now catching, each one of these V's is catching a market low. This one here was a misfire, but it's worked, meaning by worked, within 30 or 60 days, the market's higher than it was before. It's worked a very high percentage of the time.
Getting the bottom in March 2009, and the COVID, near the COVID bottom, that's fantastic. I remember during the COVID bottom, I thought there was like this one weekend where it was just the worst news in the world coming out, and but there were little slivers of good news about potential for vaccine this or whatever, and I took that as a signal. It's kind of a fundamental decision I took. But it's amazing that you found that a few days before with this volume analysis.
Yeah, it's a great read of sentiment, particularly, we're looking at not the S&P 500, but actually the spider. And that's a really important differential, because the spider moves price wise exactly with the S&P, but its volumes, it can be completely different. And so what we're looking for is the volume of those retail investors, and that makes the distinction, the important distinction of what's actually happening.
Oh, that's interesting. So it's a different set of traders. Even if it's ultimately the same instrument, it's a different set of traders using the SPY. And I guess the big institutions would be direct indexing somehow.
Yeah, they probably just own it on their own. They're doing their own. They're not going to own necessarily the broad ETF.
Right. Wow.
Okay, so this is an update of where we're at now. So this is just looking at capital weighted volume, and so you can see that it has led the market higher, and it continues to lead the market higher. So long as we're significantly above trend, this tells me that we're in a volume analysis bull market. Same with dollar volume. Dollar volume has even been stronger and faster. So it's been leading just not only volume, but it's been significantly leading price. And so this tells us we're in a very healthy bull market. Doesn't mean that it can't pause or go back, but this tells me that this is a market where you have to be long.
After you get a buy signal like that, on your previous slide, it was
like here.
Oh, okay, March of last year. How long can it take before you get a sell signal? Or I also see that the dollar volume is much higher than its moving average there. How long could this last until things start to reverse?
You just don't know. You just have to kind of wait it out. You see here that we got some, in this period of time, we had some pullbacks, and these were, considerable pullbacks. This here, you can see we didn't even have to use that V bottom because it didn't even cross under trend in the 20 March of 2020 pandemic bottom. So this is the idea here, is not to avoid a market correction. I'm not trying to avoid a market correction here. We have to be able to live through corrections. But the idea here is to avoid the big bear market, because the bear market is what destroys those financial plans. You lose 10%, you only need 11% back to get back to even. But if you lose 20%, and then take another 5 out, you need a 35% rate of return to get back to even. So that's hard to do. It still haven't, even if you took 5% out in 2022, you're still not back to even. Even though mathematically you think you would be, but the market's a lot higher. But because when you took that money out, it's really hard to make back those gains. So that's what we're trying to do here, is not try to avoid a correction. We're trying to avoid the bear market.
So 5% here or there, not a big deal. You're looking to avoid.
I'm looking to avoid more than 10 or more.
So you had the IWM, which is the ETF for the Russell 2000.
Yeah. So the large caps have been doing great. The mid caps have been the ones that are kind of struggling here. And so you can see that we have a pretty wide range between 163 and right around 210 or so, and we're at the very top of that range. We had a doji which is, where the market goes high and then it goes low and it closes somewhere in between, or it could be the opposite. But nonetheless, it closes almost exactly where it originally opened in a wide range. This now that doji defines our range. And if we were to get through 210, see if what my next chart is, okay, doesn't really show, which we're right on the cusp of. We actually were just a little bit above 210 on our close yesterday. That would be a good sign, and there really isn't a whole lot of resistance. This doesn't show it on this chart, but the volume at price, there isn't a whole lot of resistance until you get to 220. But that said, we've been hitting kind of a high peak on the IWM for some time, and it seems to kind of always pull back a little bit. So this is really I think one of the key indexes to watch, because it's not in a per se a bull on a long-term bull market. It's still in a consolidation pattern. And what I think could really give this market legs, is for the small caps to take some, to start following the generals, which are of course the large caps.
Yeah, I've seen some comparison charts of taking a ratio of the S&P 500 to the Russell 2000, and S&P's just been killing it. Russell's just been kind of stagnating. It hasn't been this bad, I think, since 2001, maybe. But we're at kind of a historic dislocation between those two indices.
There's two other periods of time where it's been. One was the 1930s, and I can't remember the other thing. I think you're right. It was like somewhere like having to do with maybe the Great Recession. It was that was right around that time period where we had that big of a dislocation. It's only happened twice.
Okay, so if small caps start, I guess it's also a signal of breadth. If the rally kind of spreads out to small caps, that's just going to confirm it. We're going to see much higher highs.
Yeah, breadth is actually doing, it's been weak. Looking at like New York Stock Exchange breadth, but more recently it's been leading the small caps. Just another example of a stock here that you can see it's gotten really, the VMI is getting really low. That means the money flow index is really pouring ahead of the RSI. That asymmetry that we started out with is really strong on Fidelity National Information Services. So this is another stock that kind of peaked right here, and then you can see the MFI really started to take off, whereas the RSI is going higher, but not nearly at the pace of MFI. So that's the type of thing I'm looking for. The other indicator I have in here is, if you use the MACD, I have a variation of that called the trend thrust indicator, which uses volume and adaptive language to make the MACD much more accurate. MACD, my testing shows it works about a third of the time, which is you'd expect in trending. When you make these volume adjustments to the MACD, it raises it to well over 50% accuracy rating or profitability rating compared to the MACD only at a third. And that which can really help your results.
Yeah, certainly. Going for anything over 50%, equal risk reward is what you want.
I think, yeah, that's all that I had for you this time.
Okay. I'd love to get a couple final thoughts about how you see the future of the markets and investing, especially with volume. So, there's more and more interest in passive investing and index funds. How do you see that working with your technique?
Well, I think that as more and more people move, and that is certainly the stronger trend to index investing. That certainly has been working, particularly over the last year or so, a year and a half. That's been a great place to be. But over time, as more and more people mindlessly invest, what that does is it prompts up those higher weighted stocks, and that's how you get in a situation where you're in a Magnificent Seven. The problem is that may be working now when the market's up, but what happens when we reverse course? There's lots of studies out there that would show that millennial generation is the most risk adverse, even though they're among the youngest. And at the same time, the people that have the money, the baby boomers, they're in the distribution phase, so they can't afford the risk. So what happens if in passive investments, if this trend of money moving in turns to outflows? And so that's where active management is going to become really important. And that's where, in particularly, risk management really takes hold. And because it's the end, it's what you're trying to do is you're trying to create a goals-based investment plan that preserves people's capital. And they'll forget you if you beat the market by 5%. We all focus on the alpha side, but when the market's going down, that's when they need us. That's where risk management and being an active manager really comes into play, because that's where you can save someone from that situation where the markets are going down, they need money, and doesn't mean that they're going to go back up. I mean, even if they do, it's maybe too late if they ride it out too long. And so that's where we can really add value, is through being tactical and applying risk management to our portfolios so that our clients can meet their final destination.
Absolutely. It seems like this passive investing trend is just going to add excess volatility to some of these top weighted stocks when the upside turns into the downside. But I also think that the passive investing trend creates a lot of opportunities for active investors to outperform.
Absolutely. Yeah, I couldn't agree more. It's a great time to be an active investor.
Yeah. Do you see? I'm curious about, like, with analyzing volume. Do you see this passive trend kind of affecting how volume is reported, or how the indicators function?
So volume is a very lit market in equities. So it doesn't necessarily, I don't see the data is great with individual stocks. And with indexes, it needs repaired. It needs significantly repaired. That's why we have the capital weighted volume and capital weighted dollar volume to repair those deficiencies. But volume is extremely relevant now as much as ever. That's what I'd say. It's actually a factor of investing.
Fantastic. Well, I'm looking forward to learning more from your book. And you have a new book coming out in July. Is that right?
Yep. I appreciate you mentioning that. So that's available for pre-order now. It's the title I just mentioned is the volume factor. And so what we do here is really twofold. My first book, Investing with Volume Analysis, which I was blessed to be the winner of Technical Analysis Book of the Year. I think that was in 2012, was all about how do you use volume as an edge and the analysis. How do you use volume to analyze securities and develop an edge. Okay. This next book takes that theme and says, okay, volume is not only a leading indicator, it's a factor. So what we do is we prove out that volume is not only a factor, but it's the strongest of those factors. The things like the Fama French model, for instance, it's like 100 times stronger than the next best factor. Then the other piece of that, and this is the most important piece of the book, is how do you take that factor and how do you implement it inside of a financial plan to drive successful investments. So it's kind of like a bridge between technical analysis and financial planning. How do you bridge those two together to create successful financial outcomes? And so what we talk about in the book is implementing strategies to like if you're using the endowment method of withdrawal, it's all about keeping volatility low. And if you're using like the income method of withdrawal, like when we talk like the dividend tree, it's all about growing income and keeping volatility low. And so how do you take that factor, use it to apply to a portfolio to move from goals-based planning to goals-based investing?
Excellent. Other than that, where can we learn more about you? Do you have a website? Anything else?
So I'm building a website. It's buffdormeier.com. There's also going to be the volume factor is also my property.
Okay, great. Well, I look forward to checking that out. So, Buff, thanks for your time today. Thanks for teaching us all about investing with the volume factor.